Hey everyone, you know what is common in most Indian households? The moment there is a little extra money, salary bonus, Diwali gift, maturity amount, the first thing we hear is, beta kahin safe invest kar do. Traditional saving methods have been a trusted home for our money for decades, giving peace of mind without market ups and downs. In fact, more than 200 lakh crore is currently parked in bank deposits across the country. Now let's talk about something else that's been around for years but only recently started opening its door to everyday investors. It's bonds. Earlier they were mainly accessible to HNIs because of high minimum investment size. But today, thanks to new platforms and digital access, bonds are available in much smaller ticket sizes, making them easier for retail investors like us to explore. So here is the real question. Why does the Indian middle class keep missing out on bonds, an option that actually fits our needs perfectly? That's what we are going to decode in this video. I'll break down what bonds actually are, how safe they are, why most people don't even know about them, and how new age platforms like Aspero are making bonds accessible for the everyday Indian. Towards the end, I'll leave you with a thought that maybe it's time we explore newer ways to grow our money. Not by taking crazy risk, but by making smarter, informed choices. Alright, let's begin. So let's start with the basics. What is a bond? In simple terms, a bond is a loan you give to a company, a financial institution, or the government. In return, they agree to pay you a fixed interest regularly and return your principal amount after a set period. Bonds comes with a predefined tenure, interest rate, and credit rating. So you know in advance how much you can expect to earn and when you will get the money back. For example, let's say you invest 1 lakh in a bond that pays 9% interest per year for 3 years. So you get 9,000 rupees every year and after 3 years you get back your 1 lakh. Simple. But isn't that risky? What if the company runs away? Good question. And this is where many people get confused. Not all bonds are the same. Some are issued by AAA rated companies with consistent, strong financial performance. These bonds are credit rated by agencies like CRISIL, ICRA, CARE, who analyze whether the company can repay on time. Now let's discuss how do you judge a bond's safety. To gauge a bond's safety, the first thing you should look is credit rating. Think of this as the bond's report card. Just like students get A, B, C grades, companies are rated based on how likely they are to repay your money. For example, AAA means the safest bet. They are highly reliable issuer like blue chips companies or PSU. Then AA plus or AA is still very safe and a common sweet spot for retail investors. A and below, they carry higher risk and should only be considered if you have done your research. Now what about BBB plus bonds? So they are lower on rating scale but not always off limits. If the company has strong financials, the bond has a short tenure and the issuer has a good repayment track record, it can be a viable option depending on your financial goals and risk appetite. Always remember, higher returns comes with higher risk. So always weigh the reward against your comfort with potential risk. Then second, corporate bonds from reputed NBFCs can be a smart move. When people think of bonds, they often imagine only government securities or AAA rated options. But some of the best opportunities lie just beyond that in corporate bonds issued by well-known NBFCs like Tata Capital, HDFC, Cholamandalam, Ugro, Indostar. These companies are trusted names with decades of lending experience, audited financials, and clear repayment structure. So here you need to look at the issuer profile. Now think about it. Would you lend money to someone you don't know or to someone with a steady job and a strong track record? That's how bonds work. A bond from a reputed NBFC like Tata Capital or HDFC is backed by a business that lends responsibly, manages risk, and has repayment history. These issuers often secure their bonds with collateral, meaning you have a higher chance of getting your money back even in rare case of default. Most of these bonds are senior secured, which means they are among the first to be repaid if things go wrong. So the bottom line is, you don't need to chase AAA to invest safely. With reputed NBFCs, short-term tenure and secured structure, corporate bonds can offer stable, high-yield option that suits investors seeking a balance between safety and return. Then third point you should check is security. One of the most common question people ask is, what happens if the company can't repay? Here please note that some bonds are secured. It means they are backed by real assets like property, receivables or equipment. So in case of default, these assets can be sold to recover investor money. Then there are unsecured bonds. In case of default, unsecured bonds holder have to wait in line for repayment. So always check, is the bond secured or unsecured, and what is the collateral backing it. Now comes a special category called a senior secured bond. Here secured means there's a legal claim on asset. So if the company fails to repay, they are obliged to sell those assets and repay investors like you first. Then senior means you get priority over other lenders. In case something goes wrong, your money is repaid before other unsecured creditor or shareholder. Think of it like this. Imagine the company has a building as collateral. In case of default, the senior secured bondholders get the first right to sell that building and recover their money. Equity holders and unsecured lenders get whatever is left. In short, senior secured bonds are the most protected in the capital structure. Now you might ask, if bonds are so good, why don't people know about this? Because earlier, bonds were meant only for the rich. Minimum investment was 10 lakh rupee, 1 crore rupee, then paperwork was complicated, and the access was only through relationship managers or private bankers. But that is changing now. Thanks to platforms like Aspero, a SEBI-registered online bond platform provider, even retail investors like us can invest in bonds starting from 1,000 to 10,000 rupee and get fixed return of up to 15%. They also get access to pre-weighted credit rating option. Now what does that mean? So pre-weighted means already researched and filtered. The bond listed on the platform are not just any random debt instrument. A research team or investment committee has already checked the company's financials, past repayment behavior, and industry risk. So by the time you see the bond, it has already cleared a basic safety and due diligence filter. Plus, 95% bond on their platform are senior secured. This saves you time and reduces the chance of investing in a poorly structured or shady product. All such bonds carry a formal credit rating from agencies like CRISIL, ICRA, India Rating or CARE. For example, AAA means safest, AA is very safe, A is okay but slightly more risk. Below A, it's higher risk but usually higher return. And you can receive regular interest payout just like rent or dividend. No need to open new demat account, no paperwork headache, and the best part, you see everything transparently on the platform. Be it issuer details, interest rate, risk level, maturity date, etc. It offers predictable returns with the potential for higher yields and better tax efficiency. Now that you understand what bonds are and how they work, the next logical question is, how do you decide which bonds to pick? Let's break it down. Now comes the most important part, that is how do you decide which bond is right for you? Because just like mutual funds or stocks, not every bond suits every investor. Let me simplify this using two broad filters. First, you should look at the goal, whether is it a short term or long term. Ask yourself, do you need regular income or you are just looking to park your funds safely for a year or two? Because the right bond depends upon your goal. If your goal is capital safety plus short term parking, then choose short tenure bonds like 1 or 2 year duration. Let's take an example. On platforms like Aspero, you will see options like IIFL Finance Limited, which is offering a AA rated bond with yield to maturity is 9.3%, minimum investment is 1027 and tenure is 10 months, 30 days. And interest payout is yearly. If you expand further, you can find repayment details and return calculator. Let's say you buy 10 units, then it will show when you will get the interest and principal amount. Then you can get further details like it is a senior secured bond. Likewise, if you're looking for monthly income, then opt for bonds with regular interest payout. For example, Mass Financial Services and NBFC is offering a bond with yield to maturity up to 9.55%, interest payout is monthly, and tenure is 1 year, 2 months, 26 days. Minimum investment is 99,387 rupee. Then second, you should look at credit rating and issuer strength. As I said earlier, always check the credit rating. AAA and AA plus are the safest. Also ask, is the issuer well known? Is it a part of large financial group? For example, a bond from a reputed housing finance company with AA plus rating might give slightly lower interest, say 8.5%, but it is more stable for conservative investor. Versus a bond from a lesser known NBFC with a lower rating, say A or BBB, may offer more than 10% but has more risk. So make sure you balance return with peace of mind. This is where platforms like Aspero help with their pre-screen issuers, share credit rating upfront, and show all details transparently. Now most people stop at AAA or AA rated bonds, and that's fair, especially for conservative investors. But here is something worth considering. triple B plus rated bonds are not necessarily bad. In fact, if you are investing for the short term, say a few months, and the issuing company is fundamentally strong with a good repayment track record, then triple B bonds can actually give you much better yields up to 14 to 15%. Of course, they carry slightly more risk compared to AA bonds, but if you do your research properly or use platforms like Aspero that already pre-vets and filter the list, they can be a smart technical addition. The key is to not allocate too much and to make sure the issuer is credible. For short tenures, triple B plus bonds can be surprisingly efficient. As far as my investments are concerned, personally I don't treat bonds as my main investment engine. That's for equities. But I use bonds to create fixed and safe income layer, like parking cash for near-term goals, creating a stable base in uncertain market, or just diversifying outside equity when I feel valuations are stretched. And in volatile years like 25-26, this fixed income layer can give you peace of mind. And also, if your parents are risk averse but tired of low return, you can introduce them to short tenure senior secured high rated bonds. It's a practical upgrade with better visibility and higher returns. So if I quickly summarize, the Indian middle class has always been smart with savings, but now it's time to be smart with investments too. Our saving habits have stayed the same for years. Safe, familiar, but not always growth focused. At the same time, equity market feels risky and most people don't have time to actively track stocks. Bonds offer the perfect middle path: safety with better return, regular income, and institutional grade opportunities. But remember, bonds are not risk-free. While the returns can be appealing, there's also credit risk, meaning the issuer could delay or default on repayment. That's why you should stick to AAA or AA rated bonds. Check if the bond is senior secured, and always diversify. Never put all your money in one bond. That's why platforms like Aspero, that are SEBI registered online bond platform provider, have made bond investing accessible like never before. Starting with just 1000 rupee, curated options, vetted issuers, and transparency that you deserve. And if you're still not confident, start small. Build trust and then take a call. If you want to check how Aspero worked, I've added the link in the description. Explore and see if it fits your financial goals. If you have any question, let me know in the comments. And if you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.
Investments in debt securities, municipal debt securities, and securitized debt instruments are subject to risks, including delay and/or default in payment. Read all the offer-related documents carefully.